All right, I want you to do something for me. Close your eyes for a second. Well, actually, maybe don't if you're driving. Please keep your eyes on the road. But just picture this in your mind. I want you to cast your mind back just a few years. We're in downtown Indianapolis, and it's quiet, maybe a little too quiet. You've got empty sidewalks, windows papered over with those depressing for lease signs, that weird, eerie uncertainty.
Oh, absolutely. I remember that. The narrative back then was pretty grim. Everyone was writing the obituary for brick and mortar retail. The headline was always the retail apocalypse.
A retail apocalypse, exactly. But now open your eyes. It is Wednesday, January 28th, 2026. And if you walk through those same neighborhoods or, head out to the suburbs like Avon or Fishers, the script is completely flipped.
It's a remarkable turnaround.
The paper is off the windows, the sidewalks are buzzing, and today we are going to unpack exactly how that happened.
We are. And we're looking at a specific report from Allies Commercial Realty, their local brokerage here in Indy. They put out a market analysis for the third quarter of 2025. And the data.
Yeah.
It tells a story that honestly surprises a lot of people.
It really does, because today's deep dive is all about the resurgence of the Indianapolis storefront. And I know what you're probably thinking. You're thinking, strip malls? Are we really going to do a deep dive on strip malls?
I get it. It doesn't sound like the most glamorous topic on the surface.
It sounds like the opposite of glamorous. But, and this is where it gets really interesting, these, boring old retail centers have suddenly become hot commodities. They are literally one of the most dynamic sectors in commercial real estate. So our mission today is to figure out why.
Well, if you look at the numbers, and specifically something called net absorption, it's actually a fascinating case study in economic resilience. It's about how we live now.
Okay, let's unpack that. You mentioned net absorption. That sounds incredibly technical, like physics textbook technical. What is that?
Sure. So simply put, net absorption is the scorecard for demand in real estate. It's just the difference between the square footage tenants move into versus the square footage they move out of.
Okay.
If it's negative, more people are leaving than arriving. The market's shrinking.
The bucket is leaking.
The bucket is leaking. If it's positive, the market is growing.
So it's basically a measure of, are we filling up the empty spaces or are we making more of them?
Exactly.
Right.
And this is where we see that V-shaped recovery everyone talks about. In the second quarter of 2025, the Indy market was taking a hit. We saw a negative net absorption of 348,000 square feet.
Wow. 348,000.
Just to picture that. That's like, what, 6 football fields of empty shops?
Something like that. It was alarming. It looked like the trend was heading down.
Yeah.
But then, Q3 of 2025, it just swung completely the other way. The market posted a positive 240,000 square feet.
That is a massive swing.
In just 90 days.
So we went from bleeding tenants to packing them in almost overnight. That's not a curve, that's whiplash. Essentially, yes. And because of that, vacancy rates have tightened all the way down to just 5.0%.
5%. And in your world, that's really healthy, right?
That's incredibly healthy. It means finding space is actually getting difficult for tenants.
And when space gets scarce, Economics 101 kicks in.
Prices go up. Rents are up 2.0% year over year, hitting an average of $17.57 per square foot. Now, it's important to note that's usually a triple net, or NNN lease.
Okay, hang on, pause there. Triple net. Krish.
We see that acronym NNN all the time in these reports. What does that actually mean for, say, the coffee shop owner paying the rent?
It's a crucial distinction. In a triple net lease, the tenant pays that base rent, the $17.57, but they also pay their share of the property taxes, the building insurance, and all the common area maintenance.
So the check they're actually writing every month is a lot higher than just the rent number.
Significantly higher. And if taxes go up, or if the landlord has to pay more to plow the parking lot, that cost gets passed right to the tenant.
Right. It shifts the risk. And despite that, demand is still surging.
It is. So why? What is fueling this? Did everyone in Indianapolis just wake up and decide to open a business at the same time?
It's not just one thing. I mean, you have to connect it to the bigger picture.
Yeah.
It's about the fundamental health of the city. You can't support retail without people and jobs. And Indy has both right now.
The Allies report mentioned population growth, didn't it?
Consistently. We're seeing about 15,000 new residents a year.
That's a lot of new customers.
It's a ton. Plus, you have solid GDP expansion around 3.1%, and unemployment was hovering incredibly low, about 3.3% in late 2025.
So people have jobs, they have money, and there are more of them. Sounds like a good recipe for buying stuff.
Precisely. And don't underestimate infrastructure. The I-69 corridor expansion has been huge for connectivity.
Oh, that's been a massive project. It's really changed the flow of traffic from the south side up.
It did. It turned areas that were once a bit of a drive into viable commuter hubs. And frankly, affordability plays a huge role here too. The cost of living in Indy attracts entrepreneurs. It's just cheaper to take a risk here.
That makes sense. It's easier to take a risk on a new boutique when your rent isn't astronomical. Which, speaking of boutiques, leads us to one of the biggest trends in this report, the actual size of the stores.
Yes, the rise of small format retail.
This really stood out to me. We aren't seeing a boom in massive department stores, are we?
No, not at all. The era of the category killer, the giant electronics store or toy warehouse, that seems to be over.
It's fading fast. The market is shifting to these compact, efficient spaces.
Aggressively.
So small is beautiful. Is it just because rent is expensive?
That's part of it, but it's really about efficiency. Right. From the business owner's perspective, a smaller footprint means lower overhead, sure, but it also means less inventory to manage.
It's like the Trader Joe's model versus a giant supermarket.
Exactly. Curated selection, higher turnover, it's more manageable. And in a market that changes this fast, you want to be adaptable. A 1,500 square foot space is nimble. A 50,000 square foot box is
a dinosaur.
A dinosaur. It takes a long time to steer the dinosaur.
And it seems like they want to be embedded in neighborhoods, not in some giant destination mall.
That is a crucial observation.
I realized the other day, I barely ever go to the mall, capital M, anymore. But the little strip center near my house, I'm there like 4 times a week.
And that is the consumer angle. People are seeking personalized, community-focused experiences. You want the coffee shop that knows your order. You want the boutique fitness studio that's a 3-minute drive.
Yeah, you don't want to trek to a mega mall for a yoga class.
Exactly. But what about the landlords? For them, these small spaces are much easier to lease.
Really? It seems like more work.
You'd think so. But if a tenant leaves a 1,500 square foot space, you can find a new user pretty quickly. Maybe a bubble tea shop, a tutor.
But if a giant department store leaves,
you've got a massive problem. That big box can sit empty for years. It becomes an eyesore, drags the whole center down.
Right. And the report calls out specific areas seeing this, like Avon, Fishers, Nora, and Broad Ripple.
I've seen that in Broad Ripple especially. It feels like every time I turn around, there's a new little concept opening up.
Okay, so we've got small spaces, but what are they actually selling? I mean, I can buy almost anything on my phone from my couch. Why leave the house?
And that raises the most important question for the future of retail. It brings us to the second major trend in the report, the necessity defense.
The necessity defense, huh? That sounds like a legal strategy.
It's an investment strategy. You have to draw a line between discretionary retail and necessity-based retail. Discretionary is stuff you just want. A new TV, fancy shoes, you can buy that online.
Easily. Compare prices, read reviews, have it at my door in 2 hours.
Exactly. But necessity, that's stuff you need to function. The daily needs ecosystem, the businesses you must visit physically.
All right, give me the list. What's on the must-visit list in 2026?
Okay, so grocery stores are the anchor. You still want to pick your own produce. Then pharmacies. But the big growth area is services. Urgent care clinics, dentists, optometrists. We call this medtail.
Medtail. Medical retail. I like that. So the dentist is moving next to the pizza place?
Pretty much. It's about access. It's less intimidating than a hospital campus. Then you have personal services. Hair, nails, wellness, and of course, quick service restaurants, especially with drive-thrus.
It's the aha moment, isn't it?
Yeah.
You cannot get a haircut on Amazon Prime.
Not yet, at least. And you certainly can't get a root canal via Zoom.
Thank goodness. And a hot latte just doesn't travel that well.
That's the point. Yeah. These storefronts are defensive assets. Yeah. They're insulated from e-commerce because they offer services.
So if you own a shopping center with a dentist, a barber, a coffee shop, and an urgent care, you're feeling pretty good. You're Amazon proof.
You're feeling very good. And the successful centers, they're strategic about creating a tenant mix that encourages cross-shopping.
Cross-shopping? Break that down.
It's when you go for one thing and stay for another. You go to the urgent care for a flu shot, and since you're there, you walk next door for a coffee as a treat.
And maybe you pick up a prescription on the way out.
Exactly. It creates consistent foot traffic all day long. It's an ecosystem.
And this works especially well in places like Carmel, Greenwood, and Noblesville, right? Where the retail is right next to dense housing.
Yes. Residential adjacency, they call it, becomes part of the routine.
The third place between work and home.
It's not a destination trip. It's part of your daily loop.
Okay, so let's recap. We have huge demand, low vacancy, and a solid strategy with these necessity businesses. My next question is, if this is such a gold mine, why aren't we seeing cranes building new strip malls on every corner? Why is there a scarcity?
That is the paradox of the current market. Demand is high, but supply is squeezed. And there's some very real barriers to entry.
What's holding builders back?
It's a combination of three main things: costs, labor, and red tape. First, construction costs are still elevated. Steel, concrete, glass. It's all expensive.
So the math just doesn't work as easily.
Right. Then you have labor shortages.
Yeah.
And finally, complex zoning requirements.
The zoning, the red tape.
It's getting harder and harder to find well-located sites for that Class A small format stuff. Communities often push back.
So if you can't easily build new ones, what happens to the old ones?
Well, first, it pushes the value of existing buildings way up. But it also creates a massive value-add opportunity.
Value add. That's just real estate speak for a fixer-upper, right?
Essentially, yes. Since new buildings are trailing demand, investors are looking at older, maybe slightly ugly centers from the 80s or 90s.
Oh, I know the ones. Beige stucco, faded signs.
Those are the gold mines now. Investors are buying those to fix them up.
I love a good makeover story. What are they doing? Just a coat of paint.
It goes deeper. They're modernizing facades, improving signage, reconfiguring interiors to split big boxes into small ones. But the real value add isn't just cosmetic. It's tenant swaps.
Like trading baseball cards.
Sort of. Let's say you have an old gift shop that's struggling. A savvy owner might replace them with a high-credit user, like a national healthcare clinic or a popular fitness chain.
And suddenly that space is commanding double the rent.
Exactly. The rent goes up, the foot traffic goes up, and the value of the whole property increases.
That's smart. You take the building's bones, which are hard to replicate, and you just upgrade the software. The tenants.
Precisely. And that's where most of the leasing is happening right now in the existing inventory.
Okay, we've painted a pretty rosy picture. Indianapolis is booming, retail is back. But I have to ask, what could go wrong? It can't all be smooth sailing.
And it isn't. There are significant headwinds, and the Allies report is very clear about this. This is not a risk-free game.
So what's the reality check?
Taxes, that's a big one.
Nobody likes to talk about taxes, but we have to. What's going on?
In Marion County specifically, property tax assessments have just jumped. The report mentions an average increase of around 27% for some commercial properties.
27%. Wow. That is a huge jump. That's a shock to the system.
It is massive. And remember that triple net lease we talked about.
Right, where the tenant pays the taxes.
Exactly. So that 27% jump is a direct hit to the small business owner's bottom line. It squeezes their cash flow.
And if the tenant can't pay, they leave.
And the landlord has a vacancy. So it's a delicate balance. It's not just taxes either. Insurance premiums are climbing.
And construction costs, even for a renovation, are still high.
Right. A renovation that used to take 3 months might now take 6 or 9. That's 6 months of no rent coming in.
So you have to be disciplined. You can't just throw money at an old building and hope for the best.
That's the key word, disciplined. Owners have to engage in active asset management.
Which means you can't just buy a building and collect checks.
No. You have to be proactive. You have to appeal those tax assessments. You have to manage those tenant relationships very closely. It's hard work.
So to wrap up, what does this all mean for us? For the person listening to this, driving past a shopping center right now?
I think it explains the activity you're seeing. It signals a shift in how we live. We're moving back toward these community-centric hubs.
It feels like we're coming full circle, from drive to the giant mall in the 90s to order everything online in the 2010s, and now we're landing on, I want to walk to my local spot.
Exactly. Indy retail has bounced back by going smaller, getting closer to neighborhoods, and focusing on daily necessities. It's more practically.
It's more about living and less about stuff.
And that leads me to a final thought I'd love for you to consider.
Hit us with it.
We've spent the last decade hearing about the retail apocalypse, right? The idea that the internet would kill the physical store.
A pretty dystopian future.
But what we're seeing in Indianapolis suggests something different. In a world of digital everything, remote work, Zoom calls, we are seeing a premium being placed on physical presence.
We crave the physical world.
We do, and we crave service. So maybe this isn't the end of retail, but a retail evolution. Maybe the store is no longer just a place to buy goods. Maybe it's becoming necessary infrastructure for daily life. It's where we take care of our bodies, our health, all social connections.
That is a fascinating way to look at it. The strip mall as the modern village square.
Precisely. And in Indianapolis, thanks to smart adaptations and economic growth, that infrastructure is stronger than it has been in years.
Well, I will never look at my local coffee shop the same way again. I'm going to see it as a pillar of economic resilience.
As you should.
Thank you for breaking this down with us. And to you, listening, thanks for diving deep with us. Next time you see a coming soon sign in your neighborhood, you'll know exactly why it's there.
Thanks for listening.
We'll catch you on the next deep dive. Get in touch with Allies Commercial Realty at info@alliescommercialrealty.com to find your ally in commercial real estate.